Good morning, good afternoon, everyone. Welcome to this week's edition of Pro9 Insider. We're going to do a just kind of review, look at some maybe tips that can help improve our trading, especially this time of year. I'm sure some of you have noticed the markets have been a bit slow or choppy. We'll take a look at how to avoid some of those situations when it may not be a good time to trade. Before we go too much farther, I just want to do a quick mic check, make sure everyone can hear the sound of my voice. Please type a 1 in the questions box if I'm coming through loud and clear. Excellent. Thank you very much. All right, looks like everything's good to go. So without further ado, we do have some stragglers who like to slide in fashionably late. So I may cover things again. And of course, you guys feel free to ask any questions that pop up during this class. That's what we're here for, is mainly a Q&A session, kind of an open forum. But until then, or until any questions pop up, I'll just kind of do a review of some trade setups. Today I definitely want to focus on identifying chop, which if you're with us last week, we did cover that, but we've had some good examples of that as well. And I've had our disclaimer up here letting you know we're looking at historical examples. And so, being that that is the case, they do have their limitations, but it is good for educational purposes to kind of go back and analyze these trades, as if they're qualified, they're qualified. So I'm sure some of you may have noticed the markets this week are fairly choppy, and that's not out of the ordinary for this time of year. Usually it seems July and August are probably the slowest months, so volume is just down across the board on most of the markets, and you see a lot of chop. So in the we have the NQ here, sorry. A couple decent trade setups this morning. Out of the gate, not real choppy. We do have a dot trend short here. Now, I really love these trades. They're very strong trades. They don't happen very often. But when they do, I find that they almost always hit their profit target. So I want to say they have higher than a 90% win ratio, but they may only pop up 3 to 4 times a month on a given market. So, but whenever you see one, I will always take it. So unless it's some weird situation where it may be heading into the low or something like that, but that seems pretty rare. So the dot trend, if anyone's not familiar, let me grab my rules real quick. So it is kind of an odd trade to spot at first, especially if you're not used to the other trade setups. But if you've been with Pro9 Trader for a while or have been practicing it, you will get the hang of it. So it'll always happen in this type of situation. You'll see some kind of, counter trend, or the market's trending in the opposite direction it previously was. So you see pre-market, we had quite a bit of a downward trend. Then we have a bit of a reversal here, comes back down, and now we're going up again. So you always see it in this midpoint. And I think they're especially strong when they bounce off the 200. This one didn't quite hit the 200, but it's pretty close. That's an additionally strong signal to me for these dot trends. But basically we're looking for our turn bar with a red dot above it. And you will see, usually you'll see the red dot trail before the turn bar. So it may have popped up on bar 2, moved to bar 3, and then as soon as this plots as a turn bar, the red dot will stick to it. So I have my turn bar with my red dot. I need my EMAs in the correct order, not the 10. For the dot trend, we don't care about the 10 EMA. It'll almost always be either between the 20 and 50 or like here, but almost always out of order. I've maybe seen one dot trend that had the 10 EMA still in the correct order, and it was just below the 20. So very rare. You'll almost always see it like this. But I have my 20 below my 50 below my 200. So good sign so far. Now, the thing about dot trends is they rarely qualify on the turn bar. The reason for that is the blue line, I find, rarely makes it to the correct side of the purple line. So since we're looking for a short dot trend here, we need our blue line below the purple line, and that rarely happens. So once I see this turn bar plot, I know it's a qualified divergent or dot trend. And depending on where the blue line is, if the blue line is close enough where I see it where I'm 90% sure that it's going to cross to the correct side, when it's this close, it's a pretty sure bet that we're just going to move right on past. I'll either put my order in on the first color bar, the DPI that creates the first color bar, or even retrace to the turn bar entry price. I like that a little bit more. That gives me slightly better odds to hit my profit target. Even though it didn't qualify on the turn bar, I still like to retrace there. But I want to make sure that it at least qualified by the first color bar if I'm going to do that, or that it will. And you may not want to do that. That's totally fine. It's kind of a more of a discretionary thing that I like to do, but I find that it works really well. But even if you enter on the first color bar, I rarely find that these get stopped out before at least hitting your profit target. So this one, enter regardless of which bar we enter on. We do hit our profit target. The runner will get stopped out by this wick here, but that just gives us another momentum entry. And then just very basic momentum trade. EMA's in the correct order, purple bar, blue line already below the purple line, and that's all we really need to see. And blue line did almost come from an extreme, which is another sign I like to look for that just kind of adds strength to the trade setups. So we kind of have a really good picture here. We bounce off the 200, have my blue line almost to an extreme. It's very close. And then we move short, so this just cuts straight across. So we have a lot of momentum coming from the extreme and bouncing off the 200. So, of course, not going to be true 100% of the time, but the majority of the time, these additional signs do add strength to the trade. So, decent. We get a dot trend here, and then a pretty decent run here on the momentum. So, but what I really want to focus on, and what we focused on a bit last week, is chop. How can we avoid chop? Because we do have this qualified continuation in the middle of this chop, right? And some may be tempted to take that, but this is pretty easily recognizable as chop. And the first thing I look for is, as we're starting to reverse, from our recent short trend, and this is, such an easy and basic way to save ourselves some headaches. Now, we may pass up on a winning trade in the middle of this, but passing up one winning trade to avoid 2 or 3 losing trades is more beneficial than taking the trades in a risky situation anyhow, and ending up taking some losing trades in addition. So it just makes it harder to make up by the end of the day. But first thing I look for is these EMAs, specifically the 50 and the 200. When that starts narrowing and the bars kind of start converging in there, I do become quite a bit more cautious. So we did have this continuation entry right here at 1010, but we're right under the 200, and pretty standard universal rule, we don't enter a trade heading into the 200. Or really technically any EMA, 200 is definitely the strongest. 50, I tend to be cautious around as well. 20, not so much, because we have some trades like the dot trend that will usually enter into the 20. Sometimes you'll see a counter trend surf trade that does the same thing. But I usually find those trades are strong enough to just push on through. But I still wouldn't take like a surf trade into the 200 EMA or anything like that. So 20 and 10 is where I use my judgment a little more. And of course, it's not always going to work out in my favor. But here we have these EMAs narrowing, and then we can clearly see the price. While we are moving a little outside of the range of the 200, we just get pulled right back in, come down, move a little past the 50, come back up, bounce around. So by this point, we should definitely be sure that we're heading into chop and be wanting to avoid any trades. What I usually like to do, I find this is probably the safest way to make sure we're out of choppy market situation. Not to say that we can't move out of chop and then head right back in, also possible. But I want to see a trade win without me and get out of this range. Because as we've seen, we can still come back above this area between the EMAs and still get pulled back in. So while we may have a qualified trade set up somewhere in here, it's just too risky to take. This is the EMAs like this is the death grip. I mean, you'll just get chewed up ultimately. So I mean, once in a while you may catch a trade where you hit profit target, and you may see those in there, but at some point, the risk outweighs the possible reward. So, and in this situation, the risk is much too high. And then also we see the blue line start bouncing around the middle here, and that's also a very strong sign of chop. So I really like to see the blue line coming from the extremes, this green line up here and the red line down here, the 135 and minus 135 levels. That's what we would consider the blue line's neutral zone. So we'd like to see that pretty consistently throughout the day. It's not always going to come above the extremes, but we do like to see that fairly consistently. So when the blue line is just bouncing around in here in the middle, back and forth, and I've got the purple line right around the 0 line, all those are very strong signs of chop. We have quite a few turn bars. Just very textbook choppy situation, and stuck in between these two EMAs. So I mean, if we're looking at this here, well, my EMAs are technically in order for a continuation. I need to see my blue line jump back across. But even if I saw this and have a possible continuation setup, I just want to wait. I haven't seen a winning trade in here yet. All I've seen is us just bouncing around this channel. So I'd be pretty skeptical about this trade. So some of these trades are very easily avoidable. And we may pass on a trade that ends up winning. But my perspective on that is you can't trade with that attitude of woulda, shoulda, coulda. You'll drive yourself crazy, first of all. Once you elect to pass on a possible trade setup, we passed on it. We made that decision. Whatever the outcome, I don't really care anymore because I'm not in it. It doesn't affect me at all. I want to just focus on making smart decisions. So even though we have qualified trade setups, the market tells us, or other indicators tell us, that it may not be the most ideal situation to trade. And then we see we do finally get pulled out of that area. So, but we could very well head back into chop. Another momentum entry here right on the 200. I'd be a little cautious of this as well. So uh, that one would probably be the first one I would take. Um, and even that would have hit profit target, and then you're probably stopped out at break even. So not a ton going on in the NQ, which isn't out of the ordinary for a Friday and through this time of year. So and of course, you guys feel free to holler any questions that pop up. One thing I do want to point out, so let me just grab a couple charts here. So very briefly, I just want to kind of go over the TF, or I should say the Russell now, because we have two instruments for the Russell. So if anyone's not aware, so for anyone who's not aware, the Russell recently moved to the CME exchange as well, so it is now both on the ICE exchange and CME. So we're likely going to see some split volume for a while because not everyone has moved to the RTY yet. I'm sure a lot of people will eventually. It is much cheaper to go that route for the data feed, whereas on ICE, the fee was about 117 bucks a month. And on the CME, I believe you can just add it to the bundle for something like 6 or 10 bucks a month, something like that. But I would check with your data feed provider for the end cost, but much cheaper. But so given with volume being down in general, and then we're going to see some split volume on these charts. The TF or the Russell has definitely slowed up, and you know, if we look back through the week, it's fairly choppy. We do have some decent opportunities, but pretty much just consistent in these very short cycles. Not a lot of opportunities to get in. So we may see that for a while. The Russell will be listed on both these exchanges until next year. So it's kind of tough to say when the majority of people will make the move to the RTY. But it will happen eventually. But until that point, I would expect to see, especially through July and probably through August as well, both of these instruments be fairly slow and choppy. So, and I'm sure if you guys have been trading this week, last week as well, you've probably seen a lot of chop. I've heard that from a few members asking if that's fairly normal for this time of year, and it really is. July and August are pretty slow months. I know last August, I believe it was markets were pretty dead, and anytime there was movement, it was just very choppy. So I would just say, you know, exercise a little more caution, pay attention to the rules. You know, don't trade into any EMAs. Be careful around the low of the day or a higher low of the day with breakouts. And I would just kind of check and see what the pattern has been with breakouts. It's one of those kind of trades where it can go through periods where the market's just not really going to push through consistently through the lows or the high of the day. So if you notice a pattern over the course of a couple days where breakouts are really not working, you may want to just pass on breakouts for a while. I know last year there was a period of time where The NQ it was maybe for a month or two, where the NQ you just could not catch a winning breakout on the NQ. It would always go 5 ticks or something like that and then reverse. Uh, so there was a period of time where we just stopped looking at breakouts in the NQ. So keep, just stuff like that. If you notice patterns, that can help us avoid some losing trades, I would just say, perk up your antenna, keep an eye on the markets. Of course, stuff like that isn't always going to hold true 100% of the time or long term, but you can see some kind of short term cycles that can help us avoid some losing trades. But TF for now, just kind of heading into chop, and RTY is pretty dead. So. In general, markets are fairly slow today. YM pretty decent trading opportunities here in the YM. And the YM right now is one of those markets that I do like to watch. It doesn't seem to be moving a ton lately, but the YM has hit record highs. I want to say it almost seems like once a month over the last couple months. I know it's hit record highs at least 3 or 4 times this year, which is pretty abnormal. I would say before that it was, I can't recall off the top of my head. I want to probably about a year before the last high was hit, and then before that it was 6 or 7 years or something like that. So we're hitting record highs in the YM more frequently. So it's definitely one of those I like to keep an eye on, because typically when that happens, you'll just see a straight long trend most of the day. So it's one of those, it has been slow. It does give a few trading opportunities. But I just like to watch it, much like the CL. CL has been kind of dead lately as well. I had a couple good days this week. But again, it's one of those where I'll kind of just keep it open and leave it on the background and just check on it throughout the day to see what's going on. And if it's just too slow, I'll just pass on it, So I'm of the opinion we shouldn't be married to any of the markets. The markets certainly don't care about us or what we're doing. So, ultimately it's does the market provide enough qualified trade setups to make it worthwhile to watch. So I usually have some primary markets that I like to watch. NQ's still been pretty good. TF slowed down quite a bit. YM as well. I think most of the markets will kind of slow down for a while. But if anyone is interested in, maybe you have maybe you're looking to trade earlier in the morning. So 1 second, let me grab a chart here. All right. The FDAX. So it's a German market. It's similar to our NASDAQ. It is open, I want to say, from like 3:30 to 12:30 Eastern, roughly. So this has been a pretty good market recently. But if you're up early, maybe something you want to take a look at. So it's not really, it doesn't seem to be affected by any slowdown like we're experiencing, a drop in volume across the board. So you can see quite a good number of moves. So I will say the margins in the FDAX are a bit higher, um, as it is $12.50 a tick. But if you can, certainly I would, something to look for. So, and I had a huge drop yesterday as well. Huge run right here, 28 bar run, followed by a couple other single T's and continuations that you can hop into with some momentum sprinkled in there. So, and as you can see, not a lot of losing trades either. So there's finally one. But I mean, coupled that with all the winners that were in there, it's feels a little easier to get dinged on a momentum. But a good alternative for this time of year, if you can, would be the FDAX, maybe the 6E or 6B. That'd be the Euros future, the British pound. I know some of our members like to look at those. They're pretty good markets to look at in the morning. So, and I think that's a good subject to cover in here as well. As what do we do when our normal markets are really slow? Because you don't want to sit around all day and watch super slow markets. It almost doesn't seem worth it, to grab one trade and hit a profit target. So there are quite a few other markets that may be worth it. I have heard actually from our programmer, he's been watching some of the precious metals lately, like palladium, platinum, silver. So those may be markets you'd want to check out as well. And anytime you check out a new market, or anytime I check out a new market, I'll put it from my perspective, I'll watch it for a couple days and maybe trade sim while I'm doing my other trading, of course, because I want to make sure that it provides enough trading opportunities to make it worth my while, and to just see how the market moves. I don't like to just kind of fly blind into a market and just decide to trade a new instrument randomly. So something to keep in mind. So I have heard, I've had quite a few people ask me this week if this, type of market behavior is typical. And it is. I know last year after 4th of July, it was pretty rough. A lot of choppy market situations. So, and this would be, one of the reasons I like the YM. Is for days like this, whereas a lot of time it's fairly slow, but pretty good run right there. So if you can grab one good run out of a market where you're not giving it a lot of your attention, it can be pretty beneficial. So. All right, anyone? If you guys have any questions, feel free to throw them out there. If you had some kind of tricky trading situations throughout the week, maybe want to analyze a trade a little bit in depth, go ahead and throw those out to me. Or if you have any general questions about Pro9 Trader, if you're new, still having a bit of trouble with the rules or money management strategy, go ahead and throw those out there as well. I guess I can go over some money management as well. I do like to cover that, but let's also talk about getting in a habit of anticipating the trade setups. So, which I think can be one of the trickiest things to learn, but once you get it down, It's very, very helpful. It did take me a while to get in the habit of doing this, but once you do, you get a rhythm going. And I always like to have a plan of an action for the bar that is currently building and the bar after that. So we can anticipate that. And one of the main ways, before I jump back here, is our DPI indicator. So mine may look a little different from yours. I have a test version for an update we'll be releasing soon. But my DPI indicator, obviously market can only go up or down or stay stagnant for a while. But I know what's going to happen when one of these prices is reached, right? So in this case, if we hit 59.16, we'll plot this purple bar. It'll be a qualified momentum entry. I may pass on it because this will be the fourth momentum in this run. And the bar's been building for quite a while. But if I hit my red DPI, I will plot a turn bar. So we can always know what will happen when one of these DPI prices is reached. And that lets us anticipate and form our plan of action before the market gets there. So I find if we can have our action steps already laid out ahead of time, it puts us in a good position. That way we aren't having to scramble to enter trades. Gives us better opportunity to get filled early by putting our order in early. So in this case, we'll take a look at early this morning. So nothing really here. Well, this was actually a qualified surf here, which we could have grabbed a quick profit target. But say we missed that one. Happened too quick, whatever. So I get my turn bar here. I wasn't really expecting anything. My EMAs aren't in the correct order. Blue line still above the purple line. But what I can say is that, well, this next bar that builds, or the bar that would be currently building, if that plots as a red bar, I want to be prepared to enter a retracement in the event that my EMAs do actually get in the correct order and my blue line gets to the correct side of the histogram. Right? Because the EMAs are almost in order. The 10's barely above the 20. It could cross if this next bar plots as a red color bar. And the blue line, it's not close enough for me to know for sure that it's going to cross, but it could. So I want to just be prepared. I'm not saying I'm going to enter an order, but now I have my action steps. So I know that if that does plot as a red color bar and I see what I need to see to qualify the trade, then I can try for a retracement entry. So the next bar plots. All right, well, my EMAs didn't quite get in order and my blue line didn't quite get there. All right. So then I have no action step, right? What I was expecting to, or what I was anticipating may happen didn't happen. I know I can't enter a single T later than this first color bar, and I didn't have a qualified trade on this first color bar. So I'm not going to be looking for any of those type of trades. But now I'm popping up into the middle of the run, and I can catch a momentum trade possibly. So if I'm using my ATMs, now may be the time I want to switch my ATM from the one we use for the money management strategy we use for the continuation, and switch that to the momentum, just to be prepared. So, and it kind of gives me things to do to kind of remain active and stay ahead of the game. So I don't surprise myself by entering a momentum with an 8-tick profit target and a 22-tick stop. So, and it's another one of those things that as you keep practicing and keep doing that, you kind of find yourself a rhythm. So anytime I get to this point, I know I'm not going to see a continuation or single T, so I want to be looking out for a possible momentum or a surf trade. So now my EMAs are in order. My blue line is on the correct side of the histogram for a short trade. I know that because I have my red background, which tells me pretty easily. So I could be looking for a momentum. Well, we get a turn bar here. No longer looking for a momentum. On the way up, could possibly see a surf, but if I look at my rules for the surf trade, my blue line needs to be, or we'll just check the super trend first, outside the neutral zone in either direction. So I see here it is not outside of the neutral zone, so I know I'm not going to see a surf trade. So I disqualify that one immediately. And I find this is also helpful is to find ways to disqualify the trades, because that can often be quicker than fully qualifying them. And as soon as you run across a rule, if you're checking the rules, going through your mental checklist, and you find a rule that is disqualified and it doesn't look like that may change by the close of the bar, we can just disregard that and wait for the next trade setup. But this whole time, I'm kind of keeping a running tally of what rules are qualified, so I know what to look out for. So now I'm heading into kind of a reversal from our short our little short movement here. And then as we head up toward the 200, catch a little bounce back. So it looks like we may be heading into some chop. Almost hit my extreme, which is something I like to see. But then I have my dot trend set up. And bouncing off the 200. So once this bar plots, it's not quite qualified. So I want to wait for the first color bar to plot and then decide if I want to enter my retracement at my original turn bar entry price or just enter on the first color bar. Because at this point, the blue line is fairly close that I'm pretty sure it's going to cross. If you're not sure, or if you have any doubts, it's much better to wait. I always follow the rule, if I'm not sure, I'll wait. I find it's much safer to do that than jump the gun and put ourselves in an unqualified trade situation. While occasionally I have done that several times, I jumped the gun a bit, it didn't fully qualify, and I ended up hitting my profit target. But it's still not something that we want to get in a habit of doing. And ultimately, the one thing that's going to help with the blue line is this is often the rule we're waiting, or the last rule that will qualify. But as you just get more and more chart time, you'll know when the blue line is close enough that you can be sure it's going to cross. And there are some pretty rare edge cases where it's very close and still doesn't, but that's extremely rare. I haven't seen it happen in quite a while. But again, and then even at this point, so let me open up a dome here real quick. And I just want to kind of go over an effective way to do retracements. I find this is really helpful. So my entry price for this dot trend would be 59.0550, right? So what did I say? 59.0550. All right, so I'm waiting for the first color bar to close, and I want to retrace back to my turn bar entry price. So I don't use the one-click confirmation. I like doing this for my stop limit orders because it allows me to do this retracement. I guess you could do it with the one-click entry, but I like doing like this because it keeps me active and focused on the trade. So I'll put in my uh, initial click for the stop limit order, and then wait if I see the trade qualify, and then I just wait for the price to come up above what my entry price would be, and put in my order, confirm my order, and then that way on the way down, I'll have decent odds of getting filled. So an extra little tip there. I do like to share. I feel it's pretty helpful for getting those retracements. And then walking through the rest of this trade, say we got our retracement. I'm not sure, I wasn't watching this at that time. We hit our profit target. Depending on if we got in on the turn bar or the first color bar, we'll hit it at the close of bar 3 or the close of bar 4. Now my EMAs are in the correct order. I'm still in this trade, likely, but as soon as this wick comes up here, it's going to stop our runner out at break even because it is going to go up above our entry price. Or actually, it looks like it did not. Let's see. 0525 and our entry. So depending, if we got in on the turn bar, we could ride that out, but we got on the first color bar, not going to happen. But as soon as I get stopped out, as soon as this wick comes up here, our bar is going to turn purple, and then I know I have a momentum entry. I can switch my ATM in the dome, put in my order at the red DPI price, and then we're in this trade as well. So, and this will give a good opportunity to go through the money management strategy. As I do like to outline the differences, each of us go with a different, we have our different preferences for the money management strategy. The way we recommend is, so we enter with 3 contracts. For the momentum, we have a 6-tick target, 15-tick stop. So we'll hit our profit target before bar 8 closes. Now, it could very well retrace a bit after hitting our profit target and stop out our runner. In the event that it doesn't, for the sake of this example, we'll continue with how we should manage this trade. So once the 4th bar from our entry plots, this is when we can begin trailing at the high of the previous bar, or the low of the previous bar if it's a long trade. Right, so my entry was, and there's a reason we do this, my entry was 5900.5, and the high of bar 10, as our high and low indicator tells us, is 1 tick below my break-even stop. So this is the first point that the high of the previous bar will be better than our entry price. Now this doesn't, so I know some of you may be looking at this and saying, well, the high of this bar is definitely higher than our break-even. And that's just the way the bars are. There is a range, a base range of the bars that will plot. That doesn't necessarily mean that that whole range was moved through, or that price range was moved through from top to bottom of the bar. So the first point, we can begin trailing at the high of the previous bar. Next bar plots, we adjust to the high of that bar, which will, unless there's a wick or tail, it'll be 4 ticks, because it takes 4 ticks in the direction of the trend to plot a new colored bar. So all of the numbers will move, the high, low of the bar will move in 4-tick increments, unless there's a wick or a tail. So once the 6th bar from our entry bar plots, now this is the point where we can widen to the green DPI. And we'd be at 5,900. And our entry was 5,950. So we went from trailing at 58.94.50 back to 5,900. So we gave up some ticks, some, I like to call them secured ticks, Uh, and really, that's okay with me. So some people, now this is where the strategies differ. Some people like to trail at the high or low of the previous bar for the entire run, which can be more profitable in certain situations, much like this one. Whereas if we look, we don't have any wicks or tails, so there's no way if we trail at the high of the previous bar that we're going to get stopped out. But there's a few issues with that. Namely, we don't know that ahead of time, so we could very well get stopped out on, bar 12 where we could have widened to the DPI. But I say I want to keep those extra ticks that I've already secured with my stop in place. Well, the next bar could stop us out, and then we have an extra decision to make because we'll have another momentum entry. Is do I want to enter that? I haven't seen, it's been a while since we've seen a long short run in this market, and that was pre-market. So I'm not extremely confident that, maybe I'm not extremely confident in this momentum trade, and I may decide to sit out. Whereas if I widen to the green DPI, I could ride over any wicks, and then I eventually get stopped out by this turn bar. So it's one of those trade-offs. Each one has their pros and cons. With the widening to the DPI, we'll certainly have times where our sixth bar from our entry bar plots, which is the point where we can widen to the opposite DPI, and then the next bar will be a turn bar and we get stopped out. And so we gave up some quote-unquote secured ticks and didn't end up being as profitable with the runner in that particular scenario. The reason why I don't mind that so much is that, if we look at it in the short term, it doesn't seem as beneficial. But if we think about it in a longer term scenario, where over time, if that gives us the best odds of taking part in these long runs when they happen, then it is more beneficial to widen to the DPI price as your stop. So, and that's really what the money management strategy is built around, is grabbing a quick profit target, whether it's 6 ticks or 8 ticks, and then giving ourselves as many opportunities to catch a runner and have the best odds of taking that whole run when we can. And if you do some testing with both of those money management strategies, you'll probably see that over time widening to the DPI is more profitable. Probably not by thousands of dollars each month, but it would probably be significant over the course of a couple months. Even by a month, you might see a couple $100 up to $1,000 better than trailing at the higher low of the previous bar. So something to keep in mind. But what I would say is that whichever way you decide to trail, just be consistent. That's the best way to see consistent results, is just to use the same strategy consistently. And you may be satisfied with trailing at the higher low of the previous bar until you get stopped out by a wick and not hopping back in on a momentum. Because we're also going to see times where we're trailing at the higher low of the previous bar, we get stopped out by a wick, which gives us another momentum entry. We hop in, and the next bar is a turn bar, and we take an unnecessary stop that would probably wipe out the profits we had secured. So I like to avoid those situations as well, because you never know when the end of a run is coming, right? I wish there were some easy way to tell, but unfortunately there's not. We don't have a crystal ball. So I like to avoid any extra decision making in trading when I can. And trailing at the DPI, once I get to that point, I think is the most effective way to do that. So. All right, everyone, we're down to the last 10 minutes. So if you guys have any questions, now would be the best time. Speak now or forever hold your peace. All right. Mary asks, how do you display the rules on the charts? All right, excellent. We have this handy little thing. This isn't actually our program. It is called Honeyview. We do have a link on our website, so if you log into Academy Day Trading, into the members area, come under Resources, and go to Essential Tips. And under the link Hover Rules, we have a few links for you. So the link to download Honeyview, it's a quick download, pretty easy program. We have the zip files for the rules. We have the regular rules and elite rules, and you can just unzip those. There's instructions to do that here, as well as how to open with Honeyview. Once you open an image with Honeyview, we have some instructions of which settings you want to change to have it display like you'll see me have. So if you want, it'll outline the rules. You won't have any extra borders like that or anything. It'll automatically snap to the size. That's just what these settings are for. To kind of make it easier to use the hover rules. And it's basically just an image viewing program, but we found it's pretty handy, better than the stock image viewer in Windows for this purpose. So pretty handy tool. I would also like to point out, if anyone's not familiar, but we do have quite a few helpful articles in the essential tips. Some of this stuff you guys may already know, but contract rollover, how to deal with slippage, how to identify sideways or choppy markets, all that type of stuff. So, and any new features. So when we come out with an update, we usually send out an email listing any major changes we made. But if you missed an update or missed the email, maybe it slipped by you, you can come in this section, our other new features, and you'll see the recent updates that we've done. So in case you just randomly update, you missed an update and then see things are different, this would be a good place to come check for that. Also, while we're here, our handy news calendar, very important. I know some people are probably tired of hearing about news, but for anyone that's new, very, very important. We want to pay attention to news. And we're really only concerned with any news with a green, red, or black dot next to it. So these are all pre-market. We don't have to worry about those. The petroleum status report is really only relevant to the CL. Some people do like to sit out of the NQ as well, or some of the other equities if they feel it can affect those markets as well. I don't really. That to me is kind of a discretionary personal decision. I really only pay attention to this news report in the CL. One thing I do want to point out though is this 9:45 and 10 a.m. news. Because we sit out from 5 minutes before and 5 minutes after news, we'd be sitting out from 9:40 to 9:50 on this 9:45 news, and then 9:55 to 10:05 for this 10 a.m. news. So we have one small 5-minute window in between these news events where we could technically enter a new trade. But I find it's probably a little risky to try to snipe a trade out of this 5-minute window, and I'll just sit out until after the 10 a.m. news. So if I can catch a trade in the first 10 minutes of the market from 9:30 to 9:40, I'll go for it. But after that, I won't trade until 10:05. And our rule is, to clarify, we don't enter any new trades during news. So if you're already in a trade, of course, manage it, especially if you have a runner. It makes no sense just to flatten the trade just because news is coming. I mean, news could hit and the market could take off when you have your runner in. Um, so, we don't want to hop out of any trades. Of course, if, we can't tell you not to flatten a trade. I know some people would be a bit nervous if they haven't hit their profit target heading into news, and may want to flatten depending on where the price is at. Sometimes, I mean, it just depends your the level of risk you're comfortable with. So I'll leave the trade in. I'm of the opinion that we have our stops in place for a reason. That's the amount I'm willing to risk. And if I was really concerned with the news and I saw a trade that happened before the news hit, and if I'm overly concerned with being in a trade before that news hit, then I should probably just pass on the trade in general. So, it's one of those risk-reward factors we have to weigh. But most definitely not entering any new trades during news. So, very important. You can get chopped up pretty bad sometimes during news. And if you look back historically, you will see a higher frequency of qualified losing trades during those news events. So, which is the main reason we sit out for that. All right, everyone, down to the last few minutes. Again, any last questions, speak now or forever hold your peace. But of course, if anything pops up later in the day, you can always send us an email to support@academydaytrading.com, and we'll get back to you as soon as possible. So it looked like the markets are kind of slowing down as we head into lunch, which isn't out of the ordinary, especially for a Friday. So another thing I want to touch on is I see someone in here who is asking me about this, so we went over markets to trade before our markets open. That would be early in the morning. Maybe you're a very, very early bird and want to get up, get your trading done in the morning. And the FDAX is pretty good for that. As far as after our markets close, maybe someone works during the day, they still want to trade, they can't really focus on the charts through the whole day while they work. You might be able to grab a trade here and there. But what do we do about aftermarket? Well, the great thing is that there's markets open all over the world at different times of the day. So in the evening, we'd be looking at the Tokyo markets, like the Nikkei, yen futures, and there's a few different variations on those. I'm not sure what the data feed cost is, but if you're interested in that, would want to talk to your data feed provider to see about those data feed rates, or the 6A, which is the Australian futures. I haven't checked those out in quite a while. I don't have a data feed for those, but there are options. If you can't trade consistently throughout our normal market hours in the U.S. So, but again, anytime you want to check out a new market, I always suggest watching it first, trying it in sim, making sure it's provides enough trading opportunities. There are going to be some markets that they just don't move enough to present good trading opportunities with Pro9 Trader. But I know quite a few people who go outside of our recommended markets, the 5 we recommend: gold, which has been kind of slow recently. But as I was saying earlier, some of the precious metals, if you're finding these markets too slow, you may want to check those out. Soybeans actually is one I've heard good things about. I haven't checked it out in a while. I don't think it moves a ton, but I think it moves in a direction consistently through the day. So it may not move a lot, but you may catch one decent move in there. So there's other options outside of these markets for when they get slow. So just throwing that out there as something to consider. All right, everyone, we are down to the end. If there are no other questions, I'll give it another minute. Speak now, or forever hold your peace until next week. I'd like to thank everyone for joining me. Hopefully we were able to cover something, add something a little new in there to help your trading throughout the day. And of course, if you guys have any feedback or there's things we don't cover, I do try to keep it focused on the basics at first. But if there's stuff you'd want us to go in more detail, shoot us an email to support. Feedback helps us create better content for you guys to help you trade more effectively and quicker. So that's always our goal here. We want these to be effective for teaching new Pro9 Trader members how to trade effectively. So always feel free, if you just, whatever it is, drop an email to support@academydaytrading.com. If we're doing a good job, if there's some other topics in there you'd want to see, feedback always helps. So again, thank you guys for joining me. I hope you're able to at least grab one little nugget that can help your trading. I hope the rest of the trading day treats you well. Hope everyone has an excellent weekend. And until next time, happy trading.